Like we're literally pushing $150 billion of issuance. That's something that is completely on chain.
Should I ask about that? I've got privacy as a backup question right now.
You can ask whatever you want. We'll just riff on it. I mean, there's.
All right, thank you so much for that. We've got an amazing panel coming up next, Stablecoins, Programmable Money in a Digital World, with a couple elite speakers joining us on stage. We've got Reeve Collins, co-founder of Tether, you may know, Diogo Monica, general partner at Haun Ventures, and a couple other projects we won't go into right now. Christian Rao, SVP at Blockchain and Digital Assets at Fintech Enablement. And, Fintech Enablement at Mastercard, and Sam Broner, partner at Andreessen Horowitz. Moderating us today is going to be Tim Copeland, the head of growth at The Block. Please give them a round of applause as they come to the stage.
Hello. Welcome to a panel about stablecoins. Very excited for this panel. I think we have a great lineup. Just to begin, stablecoins, they've kind of gone from a boring asset that you can't really trade for profit into an essential business model that was validated with Circle's $25 billion IPO. But where are they going to go in the future? Well, we have the experts here to find out. So to begin with, Christian, Mastercard and other financial institutions, like Visa and PayPal, are all innovating with stablecoins. Why are they seen as a competitive edge by traditional financial giants?
Hi, everyone. Thanks for having me. So while a lot of the things that consumers see when interacting with cards is real-time, moving the money underneath is not. And we do believe that stablecoins can really facilitate a lot of simplification underneath the hood. And so when it comes to moving value after a transaction, stablecoins can be an ideal vehicle.
Okay, and you recently did a big partnership with MoonPay. What's your sort of 2-year plan there?
So basically what we are focusing on nowadays is reducing friction anywhere where it still occurs between fiat and crypto and stablecoin, because it's not a seamless system, right? And there's a lot of companies that are playing in this space, and we believe MoonPay and Iron, with their acquisition of Iron, are very well positioned to facilitate very smooth transaction. And then you can have wallets that can transact in stablecoin. You can have wallet balances denominated in stablecoins. So there's a lot of opportunity to basically think about the next generation of fintech in so many different shapes and forms.
Okay, and you know, for the wider panel, are there risks to embracing stablecoins over traditional payment rails in terms of private key management and any other issues that arise from dealing with blockchains?
I'll jump in. I say there's definitely risks like anything else, but one of the things that there is a bunch of advantages. And in fact, if you take risk as a holistic view, from a stablecoin perspective, stablecoins are, if you think about it, narrow banks. $1 of a stablecoin actually has a representation of $1 at some GSIB or a T-bill. That's actually much better than having $1 in a commercial bank, where what they're doing is they're actually doing loans with that. So it's actually less risky to hold $1 of stablecoins in terms of actual risk of the banking balance sheet than it is to hold $1 at a commercial bank. So that's actually an interesting point of view that inverts the risk spectrum.
So, good to see you all. Like we really jumped right into this. I think we're all here because stablecoins are as cool as possible today. My sense is that stablecoins are not better just because they're a narrow bank or because they're crypto or because of this, that, and the other. They're cool because they represent better money. They're programmable. They're nearly free to send. You can send them across the globe instantly. And so when we talk about the risks of using stablecoins, I think it's probably worth looking at the risks of using the traditional financial system, where you can get locked out by an unfriendly government. You might have to pay taxes. You do these other things that, of course, you have to pay taxes. But I mean, you might have to deal with onerous fees that like don't allow you to use the money the way you'd like. And so when we look at stablecoins, yes, they're like pretty secure. Mostly they're narrow banked. I don't think that's actually permanent. I think likely we'll have like deposit-backed stablecoins at some point for capital efficiency. We can get into that if you'd like, Tim. But the key thing to remember is that the infrastructure has improved so much over the last 18 months that now I think most users across the world can actually use stablecoins safely and have a good reason to do so.
And I fully agree. One thing that how we look at it, and it's just a different perspective, is you have now fully digital money, and that's very innovative, because up until then we only had sort of form factor innovation, right? You had a MagStripe card, you had a chip card, a mobile phone, and now you can basically move money on-chain directly, and it can be irreversible. And I think that is something where, next to the technology from a risk perspective, we need to see how does consumer protection work, how does data privacy work, as per your comment, Tim, because I think it just poses new challenges, right? If I push money, 200 USDC from one wallet to you, and was the wrong address, I want my money back, there's no mechanism. So I think there will be, let's call it, layers of value add or whatever, to sort of have these dispute resolution mechanism, aim for global interoperability, and so on and so forth.
This is another one of my favorite topics. Like, we get so caught up in the fact that with a wallet and another, you have a wallet, I have a wallet, we can permissionlessly send money across the world. But look, you work for Mastercard, Christian. You guys, to some extent, have helped invent the modern world of payments. And to do table stakes payments today, you need to have chargebacks, you need to manage taxes, you have to have fraud protection, you need identity. And I think that we're going to see over the coming months and the coming years that stablecoin payments get upgraded to have table stakes payments functionality. So that's integration into enterprise resource planning. It's integrations to tax software. Again, it's the things that Mastercard is currently doing, and you guys have done a great job offering cards that are backed by crypto wallets, and that's step one that makes stablecoins spendable at any Mastercard-enabled terminal. So thank you for that work. But it's going to be exciting to see when stablecoins are able to be used natively at cash registers or for B2B payments while being integrated into the software and adding the capabilities they need to be used everywhere.
Let me just add one thing, which is I think part of the success of stablecoins is the fact that they're a simpler building block. And so we are discussing these value-added services, but the reality is that the market is telling us they don't want that. They don't want these value-added services for all of their transactions. And there's actually tons of value in building on top of this simpler building block of infrastructure. And then, yes, for the people that want chargebacks, for all intents and purposes, somebody can underwrite the risk. But that's a value-added service, should not have been part of the original base building block, which I think is part of the reason why this is actually so successful, is because as an engineer, I can slice and dice what I want for my infrastructure. Yeah,
so I wrote a piece about 6 months ago called why stablecoins are eating payments. And a core example in that piece is the example of going to a coffee shop and buying a $2 coffee. If you buy a coffee at a coffee shop, you're getting the coffee on the spot. And yet, MasterCard and the issuing banks, I don't want to display MasterCard here because MasterCard's actually only taking about like 15 bips of that transaction. It's not that much. The issuing bank is getting almost 25, 30 cents. The coffee shop should be getting almost all of those $2. The value-added services there, which is like fraud protection, identity, and a few other things, are likely not necessary in a transaction that could easily be handled with cash. And so a simpler building block is really useful there, and I think it's something that people are really beginning to gravitate towards.
And I agree, but I think one thing that we bring and global payment networks bring is highly efficient interoperability, right? So we have 3.5 billion cards, and the basic promise is, you have a card issued out of Chile, you go to any merchant in Canada or in Mongolia, you tap your card, it will work. There's no questions, what chain, what QR code, oh no, sorry, I'm NFC. So if you're in a high frequency, low transaction value environment, payment. There's inherent value in that. But I fully agree with both the statements that you were making. Payments is a very, very heterogeneous landscape, right? You have consumer to merchant, you have B2B, you have low ticket, high ticket. So that abundance of choice in technology that will only, it will grow wider, and consumers will choose whatever they consider most convenient and most efficient.
Yeah, okay, super interesting discussion. So how sustainable are stablecoins if US Treasury yields drop? Like, what happens to the economics?
I can jump in, and one of the things that is interesting is I was part of the Libra DM board when Facebook was trying to create this thing with a consortium, and we talked about this and modeled this at pretty high extent. If you recall, lots of the issues that we've had with the original stablecoin issuers of not having a transparent balance sheet, part of the issue was that interest rates were at 0 at the time, and we didn't have like juicy 4.5% yields from T-bills. The reality is that one of the things that we're seeing in stablecoins is nobody was willing to pay anything for stablecoins for trading. And as the use cases have evolved to higher value use cases, B2B, payouts, pay-ins, there's all of these, let's call them routers and intermediaries like Bridge and BVNK that actually are charging for these transactions. What that means to me is that in a world where interest rates come down, you have two main ways of making money. One of them, obviously, you charge on a transaction basis, where value that is actually being minted and redeemed on your chain there's value being captured. And the other one is obviously like you do either platform fees or other value-added fees by adding some of these niceties on top of these stablecoin payments, reversibility, whatever, transaction financing, re-underwriting, and value-added service on top. Those are the two obvious models. The reality, though, is that we know that good money chases bad money. And so to a conversation that would be really interesting with Sam, which is, will stablecoins go the path of bank deposits? I would say probably not, because why would you ever hold a stablecoin that goes after a path of a bank deposit if I literally have something that is strictly better, which is something that has liability directly from the Fed? So good money chases bad money. And I think that is going to be one of the phenomenons that we're going to have to see what that happens once Treasury bills are going to come down, is all the stablecoin issuers wanting to go further on the risk spectrum, doing stuff that generates more yield for them because they're not making as much on T-bills, and the consumers wanting to obviously maintain risk as low as possible, because that's part of the reason why stablecoins are so great.
So there's a lot in there, and I think there's two things to talk about. I think we could talk about both of them, actually. The first is, are stablecoins as narrow banks, as in fiat reserve stablecoins completely backed by treasuries? Is that the final model? And we'll discuss that in a little bit. Let's just hold on to that for 1 second. The other thing is, what is the business model for basically all financial institutions today? You basically take a fee on flow or a fee on float. You either take a net interest margin, the yield, or you charge a transaction fee like a Mastercard would. And right now, what's so wonderful about stablecoins is that there's basically no fee on transactions. Because if you're on a layer 2 blockchain or on Solana, it costs less than 1 cent, takes less than 1 second to send money anywhere. And that's incredible. And so we're left with a business model that mostly looks like a fee being taken on yield. It's the fee on the float. And right now, while yields are high, the revenues are fairly strong. But what we're seeing as the market evolves is that more issuers are willing to give part of that yield back to distribution, because they want to get those stablecoins out there. And so it seems likely that over time we're going to see two pressures. One is the pressure of liquidity, where being the dominant stablecoin gives you actually great network effects because you have best pricing for almost every transaction. Today, Tether and Circle are in the position of having the best liquidity. For everyone else, they're probably going to be fighting for distribution and therefore giving up a lot of their yield. And so I guess just to answer this question of what happens when yields fall, my guess is that it actually won't matter so much. Yield is going to represent the amount of money that can go to distribution minus a couple bips, which the issuer is going to take and keep. So the business model is likely to be over time that an issuer has a small management fee and the rest of the yield gets distributed to users one way or another in order to reach the final customer. We can do the narrow banking point later, but that was the point I wanted to make here.
And I wholeheartedly agree with that. If interest rates fall, yes, the centralized entities might make less money, but it's not going to impact the consumer. They're still going to utilize stablecoins. And that's the beauty of the stablecoin. It's really about how it's changed access to dollars, first of all, and then that's evolving as well, because stablecoins aren't going to just be backed by dollars anymore. You'll see all these euros, yens, and all the other currencies are creating their stable coins, and they're finally getting a little traction. But more importantly, other RWAs that yield much higher than just treasuries will be utilized to back stable coins. And as he shared, that yield will be shared with the user, because people won't stand for these centralized entities taking billions and billions of dollars of profit, and all they get is the utility. They want some yield. And the technology is evolving to make it easy for the entities to provide that yield. Therefore, the users won't stand for not receiving it. So at the end of the day, what's going to happen is consumers are going to get a better product and have better service, and they're going to earn more when they spend. And so overall, this evolution of stablecoins is super positive for the world. And all of us here that are fortunate enough to live in developed countries, we don't feel the pain as much. When you look at Tether announcing last year, year before, that they're moving to El Salvador, people might scratch their heads like, why did they do that move? But the reason is because Central America, Latin America, South America, they need it the most. Like, they feel the pain. And so who really is benefiting from this evolution of the stablecoin? It is those that were left behind. And so to me, after being in this specific space for 10 years, it's really incredible to see the impact it's made on the world and how it's leveling up a lot of people that never got to participate before.
And Reeve, talking of giving out stablecoin yield, you're obviously backing a project called Stable, which is doing exactly that. How does the economics work? Because typically stablecoin issuers make money from the treasury yield. If you then give that out to consumers, how does the business make money?
Well, that is the beauty of blockchain and of decentralization, is that technology and software is there today to replicate what a lot of people used to do, and a lot of regulations and a lot of governments did with oversight. So that was all baked into the business model, and it was super expensive to maintain and to run a bank. But now when 100% of those services can be done on-chain in a decentralized manner, meaning no one really needs to oversee it and it's all done by technology, then that lion's share of the yield can be given to the user. And the technology can take a small fee, whereas before it took all of the fee because I had to provide a lot of services. Now that's not the case. So what does Tether do? You give them $1. What does Circle do? You give them $1. They buy treasuries. They keep all that yield, and then they mint a stablecoin. But now treasuries and other RWAs, high quality, traditional investments are coming on-chain. Low risk, high yield. They're on-chain. So now the users can buy that tokenized on-chain asset and back a stablecoin themselves and take the yield. And it's just a technology fee. That's how the users are going to reap the largest portion of the reward.
And Diogo, a minute ago you were talking about stablecoins taking a cut on sort of payment flow. What do you make of stablecoin projects potentially moving to their own blockchains? For instance, we've seen recently Bitfinex has been backing Plasma and Stable, a different stable. What do you make of that trend?
Look, I think in general the game theory is that they should support all chains because it's essentially free for them to do mint and redeem. The only thing they have to do is support their smart contracts or a different chain. If I was running that business, I would obviously love to vertically integrate everything on my own chain, because now I have another business model, which is I have a native gas fee or platform token or whatever that I can actually generate revenue from that can then sponsor and add to my actual P&L. And so it's a new business line for me. And I could actually make money out of the whole ecosystem that is being developed out of this chain that I'm actually heavily benefiting by issuing my own stablecoin on top. And so I think the game theoretical version of this is that I'm going to take my money that I'm making on my fees and I'm going to try to actually vertically integrate. I do doubt that the general end game of the world is going to be specific layer ones that are highly centralized and the only thing they do is stablecoins. That is one potential path, in particular because there's so many stablecoins. The more fragmentation there is of stablecoins, the more you want of a central clearinghouse where you can basically do one-to-one redemption between all of them, and you basically solve this FX problem of USDC on Solana is not the same thing as USDT on Tron. Those two things are not the same. And in terms of risks, they're different. Treasury balance sheet is different. Backing is different. Obviously, the chain's risk is different. The smart contracts are different. So you want something that is the one angle in which I think these specific vertical integrated layer ones make sense. But in general, as an issuer, you're just going to go to all of it, try to dominate all of it. And right now, we're seeing all of these layer ones actually pay the issuers lots of money to actually have it be issued on their chains. So that's how I think the game theoretical version of the world ends up at.
The original question is like, why would a stablecoin make their own L2 effectively? Why would they have their own blockchain? The reason why you want to have your own blockchain is because you think that you can capture a network effect, you can own an ecosystem, you can make money from fees. One thing that I hear a lot from founders, and it always seems like an interesting idea, is can I take a percentage of all of the flows on a blockchain? It's actually really hard to do. How do you know how much money is being sent around? It sounds intuitive, because we do it when we're in the traditional finance world. But go to the engineers in your team, or maybe you're thinking about it yourself, and realize that it's surprisingly challenging, because you can always wrap an asset, you can hide money in an NFT and so forth, and it's pretty difficult to make sense conclusive. So ultimately what we've seen is that people are doing this sort of like stablecoin L2 narrative, but often the value accrues to where an ecosystem exists. Because if you have payments, you likely need other products. You probably want lending. You probably want identity. You might even want social networks, or you might want logistics. There's things that come along with payments, and so it makes sense to have a general purpose, I would call it a Turing-complete blockchain, with a lot of usage in order to sort of maximize the value there. There's one other thing. I mean, you were talking about this idea of a clearinghouse. I wrote a paper last week, and I recommend you all look it up and read it, called 3 Issues That Are Not Yet Being Taken Seriously Enough in Stablecoins. And one of the big parts is about a central clearinghouse for stablecoins. You likely, I think we will likely be in a world with many different stablecoins, each sort of like vying for attention in this broad ecosystem. And in order to make that world work, we need them all to be redeemable at par. We need to make sure that 1 USDC is worth 1 USDT, is worth 1 USDG, and 1 USD1, and so forth. But the solution to that is not quite as easy as it might seem, and I encourage you all to think about it, and then, I don't know, hit me up and tell me what you're working on, because it's a problem I really want to see solved.
And how have stablecoins laid the foundations for bringing tokenized assets? Like, are they the gateway drug for real-world assets on chain?
Absolutely.
Gotta be, yeah.
Yeah, right? So it's step one, if you really rewind, is stablecoins have taught people how to use wallets and blockchains and do transactions. And it's taken a decade for us to get here where the world is actually paying attention and cares enough to really lean in. And like it or not, Donald Trump did an amazing thing for crypto, as we can all admit. Which is just shift the SEC and the government's focus away from penalizing everyone and attacking everyone to supporting it. And that is the biggest thing that paved the way for RWAs, is that institutions and then entrepreneurs can get involved and not have the threat of the government coming after them, so they can experiment. So now that there's stable coins that laid the foundation and the government regulatory winds are at our back finally, these new types of assets can be tokenized, because tokenizing the asset gives global distribution. So again, if you're in the United States or really developed nations, you have sophisticated stock markets and a large percentage of the population can participate. But now when they're tokenized, it democratizes access to it for everybody in the world. It's going to take a little while for us to get there, but we're getting there one step at a time. And so I believe almost all assets will be tokenized, because we're not going to think of them as tokenized. We're just going to think that we want to buy this asset, or we want to do this transaction, or we want to be involved in finance. And there's not decentralized finance and centralized finance. Soon people will just want to do transactions, and we'll have this entire new ecosystem and a new way to do transactions that is 100 times more efficient and globally connected than what we have today.
My sense is that real-world assets are a much bigger category than we give it credit for. Like it's everything. It's all of the finance we've done so far, and we're trying to put it on chain. And so when you look at what has succeeded in real-world assets, from a narrative perspective, it's been many things. It's been startup equity, and it's been art, and it's been this, that, IP, but real estate. But the things that have actually been the most successful so far have been wrapped treasuries, basically just wrapped treasuries. And I think there's a lesson to be learned in that. Like, what does bringing something on-chain do? Well, it makes it easier to do price discovery. It makes it easier to move. It makes it easier to do lending against and DeFi and so forth. For the really illiquid assets like art and real estate, you might not benefit as much from being on-chain because we don't really have a sophisticated process for repricing and selling those assets in the first place. Like, that's just not part of our normal life. Art isn't as liquid as a treasury. That's just not the way the world works. We probably want to be honest about that. And so treasuries are where we're starting. And I think the treasury use case is actually pretty easy to define. If you're a corporate treasury with an international scope, then it would be helpful to be able to always have access to your treasuries to take loans out in local currencies. It'd be helpful to, and this is not possible to do today for many companies, to know exactly how much money you have in your treasury. That's much easier to do with tokenized assets. And it's 24/7, 365, instantly transferable. And so I think that category of real-world asset, where we're really upgrading something for a defined user, is where we'll likely start.
I'll add two things, which is another two advantages, obviously, are instant fractionalization, where by wrapping something, you immediately inherit that. Obviously, you have the programmability that we keep talking about. And then the major advantage of RWA, and if you want to see it this way, actually, stablecoins are RWAs. Stablecoins ultimately are tokenized dollars. And so they're on the leftmost edge of the first thing that we did was we tokenized dollars. Then we tokenized dollars that yield, which are the money market funds and the treasuries. And I think in terms of sequence, the way that it goes is it's dollars, it's money market funds, it's fixed income, it's private credit, it is stocks, so traditional equities, and then you go down the low liquidity elements of art and real estate on the tippy top, so on the edge, the things that are the hardest to do, because ultimately the thing that we do when we do an RWA, when we tokenize it, is we have to have a linkage between ownership of it off-chain to ownership of it on-chain. So anything that is extremely hard to change off-chain in terms of ownership, like a property, like a house, also becomes very hard to change in terms of to put on-chain. And then the ultimate thing that I want to say is that the biggest advantage is of tokenization is the biggest advantage of stables, which is they are global from day one. It's this global phenomenon where before, if you were a fintech and you wanted to go to 150 countries, you had to go to 150 countries, get compliance in 150 countries, get local partners in 150 countries, do reconciliation in 150 countries. And now what you do is you actually already know that those 150 countries have at least one player, but really 3 or 4, that settle to a shelling point called a stablecoin. And so it inverts the model of integration, where now you can integrate with one thing, which is the stablecoin, and you are immediately global from day one in 150 countries. And that's the same thing for RWAs, that advantage of being global first. So you get liquidity that is world liquidity. So the same way that we were talking about, and we had Reeve talk about how holding dollars is one of the main use cases outside of trading, number 2 use case for stablecoins, where if somebody in Argentina was already trying to hold dollars, but now they have an easier way to hold dollars, they also want to hold Tesla. They also want to hold Microsoft. They also want to hold NVIDIA, and they can't. And so it's the same exact thought process that is actually now applying to equities and tokenized equities that is applying to dollars.
Yep. And Sam, a minute ago you mentioned USD1. What do you make of having a stable coin that's tied to a sitting president? Is that like a long-term benefit for the project, or is that kind of risky?
I don't think I need to weigh in on that project in particular. I think that the key thing is that we probably want compliant stablecoins that are held to a strong regulatory standard, and we want entrepreneurs who are going to do the hard work to build integrations for them to be in fintech products, in customers' pockets, and building cool new things people want. And that's sort of my main focus as an investor.
Okay. And do we think stablecoin legislation will be passed into law by August, as Trump has asked for?
One of the great things about being an investor is you don't have to be a future teller. You just have to sort of make directional bets. And I think we're likely to end up with clear rules of the road in terms of how stablecoins operate, based on fair, thoughtful legislation in the U.S. I really like what the Genius Bill is describing, but I wouldn't know if anyone up here would be able to give a really concrete answer to August, although I'd love to hear Diogo.
I think it's going to be a cop-out, but the way that I'm going to answer this question is the way that we judge future events likelihood is by looking at the stock market. And if you look at Circle's valuation. And if you look at the amount of banks that are calling us at Anchorage and all of the traditional institutional players that after Genius Act was actually passed in Congress, the pickup to me indicates that it's soon and that will happen. I don't know if it's August, but the markets are voting, and the markets are voting yes.
Okay. And there's clear tension between onshore and offshore stablecoin issuers. How do we see that playing out?
The rules are very clear. You have to be an American coin issued from the region of Washington, D.C. To actually be considered a stablecoin in the United States. And I think that's, it's what's in the bill, and it's likely a fair outcome. So if you are a stablecoin issuer and you're outside of the United States, to do transactions in the US, you have to come and be regulated. I think that's ultimately actually a better path for stablecoins so that we avoid some of the lack of transparency that we've had in the past.
Okay. And are there any obstacles that could get in the way of stablecoin legislation being passed?
So many. I mean, have you seen American politics lately? There's nothing but obstacles. It's obstacles all around. So look, it is highly likely that it will pass, but we know how these things work in Congress. Things that look guaranteed to pass, last minute there's someone that decides to extract more out of this bill and to kind of like get some concession for their constituents and get some money for their state or whatever it is. This is just how American politics run. And so yes, there's likely to be obstacles, but the momentum is behind it, and it would look very bad for everyone involved, no matter which party you're in, for this actually not to go to the finish line after so much commitment and so much like noise has been made about this being passed.
And what did we all think of the Circle IPO? Do we have any particular thoughts on the valuation?
Well, I mean, just off the top, it's amazing. It's just an incredible indicator for the industry and how much excitement and enthusiasm there is. Now, is that based on reality? Is it justified, their valuation? No, but it's okay. That's how the stock market works. It's just a really good indication of where we're going, though.
I think there's two ways for you to look at it. So there's the traditional public markets equity investor way, which is you look at NTM revenue and you create some kind of multiplier, and then you realize that the public market investors don't have any other way of doing a clean bet on stablecoins. All of us are making a ton of noise on stablecoins being revolutionary and being the new money rail of the internet. And we keep making this noise, and you're a public market investor and you hear this, and your question is, how do I get exposure to this? Buying USDC or USDT is not going to help you because that doesn't generate any yield or really benefit from appreciation. So the moment there's one equity that comes public that has that narrative, which is Circle, one exclusive narrative, which is stablecoin success, then all of a sudden, of course, you're going to have this anxiety about owning this stock, and then more buyers than sellers means that the price goes up. One way to look at it is it's not justified really on a revenue multiple. The other way to actually back into it is pretty interesting, and it's been around on Twitter, but it is Coinbase owns a significant percentage of Circle. And at the valuation of Circle, right now, Coinbase's shares are worth so much that means that Coinbase's valuation at $60-something billion is only being priced in. The rest of their business that is not the Circle shares is only being priced in at like 2x revenue or 3x revenue, which is kind of a ridiculously low amount. So, the public markets are saying us two things at the same time, and they're contradictory to a large extent. They don't make sense with one another. So I'm expecting that either Coinbase shares have to go up because the market has to recognize that those shares of Circle are worth a lot more than they're actually being priced at, or Circle shares come down and there's some more rationality in terms of like what the revenue actually is.
For me, the Circle IPO is exciting, and it's great to see how the market has responded, but the most exciting thing is that it caps off what was obviously the most exciting spring for stablecoins that we could have imagined. And that is to say, Visa and Mastercard, MoneyGram, Stripe, and countless other businesses decided that this is the time that they're going to make an investment into having stablecoins being the backing for their fintech. And that's because stablecoins represent better money. It's faster, it's cheaper, and it's programmable in a way that traditional rails are not. And so the Circle IPO is what it is, and we'll follow that narrative over time. It's certainly exciting. But the main thing that we all want to be tracking is how many big incumbents are investing in stablecoins for the future of their products, because that's ultimately what's going to lead to more adoption in the near and medium term.
I'll also play on this narrative. Another thing for you to look is in an ecosystem like crypto, one of the healthy things that happens is there's very healthy M&A. And in the past, we haven't had really billion-dollar acquisitions. And just in the past 12 months, we've had 4. And I think Circle IPO is yet another mark on this path to crypto becoming a very legitimate, a very mainstream type of ecosystem. And so that's actually exciting. And it plays to the narrative of major IPO, over $20 billion valuation, following 3 or 4 multi-billion-dollar acquisitions of companies in the space. So obviously, as venture investors, we're very excited, right? We're very excited for this because it actually creates this cycle of funds and money that gets reinvested in the next startup.
And another issue with stablecoins is the question of privacy. Christian, how do you handle that with Mastercard in terms of respecting your sort of users' privacy?
I mean, the way we use stablecoins essentially today, to think about it simplistically, it would be a 40-second or whatever fiat currency. So the transaction anatomy that we have stays the same. So we don't know who Tim is. We have a 16-digit card number. We don't know what you buy. So we just know that somebody wants to buy something and we need to move money. And then this is all aggregated into clearing and settlement files, and then the bank that your card is issued from essentially moves money into the Mastercard system, and that money then moves to the acquirer. And this can be done way more efficient with stablecoins, but at the end of the day, if you use stablecoins for settling transactions that we would use them today, we do use stablecoins for that, it doesn't change the privacy that you enjoy today. And that's back to my point. If I chose to use a stablecoin wallet directly and would do indirect on-chain transaction, obviously that changes. So that's why I think there will be layered or different distribution models for using stablecoins, because I believe that the global network of interoperability, that doesn't care about how the money is moved, right? I have a card with a red and yellow circle, and I know that this works wherever. Whether the money is moved in ACH, in stable coins, or the merchant gets it next day or whatever, I trust that card. It works. I get my merchandise, my data privacy is protected. So from our point of view, we see stable coins in this department. But I see, Sam, you want to speak to that?
Well, yeah, this is the privacy point is one of my favorite things to talk about, because think about what your expectation is for privacy today when you get paid or make a payment. Are we all really assuming that that's the most secure private thing in the world? Obviously not. Everyone knows where you work. They can look that up. If you really wanted to, you could subpoena someone's records, get Mastercard to turn over what you paid for the coffee that you bought earlier today. And so we live in a world where our main sense of privacy with payments is that your friends and family can't easily look up what you spent somewhere. That's sort of what the expectation is today. And so stablecoins might actually today have slightly worse privacy guarantees than that. But it's not hard to imagine that we could come up with a compliance solution that offers a better privacy guarantee than what we have today, without it being end-to-end encrypted. I think sometimes we sort of throw that out there as a goal for stablecoin payments, that we're going to make it so that you're totally anonymous and the amount you spend is totally confidential. But maybe that'll happen, and maybe we can figure out how to do that in a compliant way. But I just don't think that's the standard we're holding traditional payments to, and so it's not the standard that I'm going to hold sort of the near-term stablecoin payments to either. I think it's a lower barrier to entry than that.
I would disagree to a certain extent, and I think that also ties back to regulation. If you want to move from 2 to 5% of people who say, "Oh, I just did an on-chain transaction, I'm so excited," if you want to move that into the mainstream, you will need to play by the same standards, that is consumer protection, data privacy, and so on and so forth, because regulation, a good way, putting consumer interests first and then aiming for sort of nuanced and sustainable innovation, will look at that, because consumers, at least in the West, and that is different for a different market that Tether is working for. In the West, you have all these choices. You have 5 wallets on your iPhone. So if you want to convince consumers to adopt a certain payment mechanism, you need to be on par. And if you want to convince merchants to accept a certain payment mechanism, you need to be on par when it comes to addressable market, conversion rate, throughput, and so on and so forth. So that's why I think that there will be different value systems or different verticals. Some will be purebred stablecoin, wallet to wallet, because that's what I want or that works for that very scenario. But others will be, I use stablecoins essentially as a digitized version of money that can flow freely, but there will be sort of interfaces or consumer interaction mechanisms such as card, right? We're not tied to cards. A card used to be in my wallet, now it's on my phone, and who knows where it will be next, right, with the agentic AI and all these things.
Yeah.
So can I just I'm very positive on stablecoins. We were investors in Bridge, we're investors in BVNK, we're investors in lots of companies. But let me just recognize that is an extremely sad state of affairs for an industry that prides itself on having incredibly advanced blockchain technology and cryptography technology, where we keep pushing the boundaries of zero-knowledge proofs and fully homomorphic encryption, to end up with a step backwards in terms of privacy. I am sorry, but the current state of stablecoins cannot be the future state of stablecoins, because it's an extremely sad state of affairs if we as an industry allow ourselves to basically have settlements and transactions that are just publicly, freely available for everybody else in the world to see. And we know for a fact, all of us, that there's technology that we've created as an industry that allows us to meet all of our compliance and regulations. I literally created a federally chartered bank in the United States. We're meeting all of the regulations and rules. I want to meet those regulations and rules, but we know how to do it in a way that protects the privacy of our consumers. So let's just recognize that stablecoins are positive expected value. They're extremely good force in the world. They're giving us more optionality. They're much better infrastructure. But right now, we are not at its final state, and we cannot have this lack of privacy be the final state of affairs of stablecoins.
Okay, and then very quickly, Sam, where do you see the most exciting investment opportunities regarding stablecoins today?
So we're saving this for with 1 minute left on the panel. I think that's perfect timing. I got 10 minutes to talk about this. Look, what's so exciting about stablecoins is that the market structure is not yet determined, and the future of stablecoin adoption feels very path dependent. We could end up with a bunch of issuers. We could end up with a small handful. We could end up with a bunch of orchestrators. Or we could end up with a pretty open field of tools that compose together. The way I've been looking at investing in stablecoins is to say, there's going to be the infrastructure that is enabling stablecoins, so the layer 1 and layer 2 blockchains that make this possible. There's going to be the tools and add-ons and modules, oftentimes focused on privacy, wallet and custody, yield, and so forth, that are making stablecoins more usable for more customers. Oh, also merchant acceptance and payment, sort of table stakes payments things that I talked about earlier. And then the last category that I'm probably most excited about is, what are the applications that are uniquely enabled by having an instant, nearly free payment mechanism that's infinitely programmable? And we're seeing all sorts of things here. One is, remittances are sort of the first, but we're seeing people do loyalty apps and fintechs that cover new niches, streaming payments and microtransactions. And so I'm looking at those use cases and saying, wow, we've got this new platform. What are people going to build on it? And that's where I'm spending a lot of my time right now.
Amazing. Thank you so much. Can we have a round of applause for our amazing panelists?
That was really fun, guys. Thank you. Yeah.